Best Moments episode of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hello, everyone, and welcome to the newest episode of Futures Radio Show, where we will highlight our favorite moments of the show over the past month. But before we get started, I want to thank all of our sponsors: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. So without further ado, let's dial into those top moments of the show this month. I think most traders are very visual. I think that's why so many people they choose technical analysis versus fundamental analysis. They like to see the chart. They like to see, what's happening, and you like to see the order flow. But talk to me about some of the specific things that you were taught in those moments next to that bond trader, and then and how you accelerated it on your own, and then basically building your own book of ideas, and then eventually taking that to your trading.
Yeah, so at the time I was really dumbed down. I was getting into Fibonacci stuff, and I started discovering rotations, and all that stuff has its purpose, but I kept battling myself on why does it stop there? Why did price just doesn't stop for no reason. So what he showed me was basically how the order book works. You have order pressure on top, order pressure below, how bids are bought into the offer, and just basically the mechanics of the book, that you buy from someone selling it and you sell to someone that wants to buy it. And that all made sense to me. So he showed me a few things, a couple drills to do, these like 1 to 3 tick drills, and for the life of me I couldn't do it. I couldn't figure it out. There was too many numbers flying up and down. So I started creating my own kind of order book on the chart.
So you said you're creating your own order book on the chart. Can you give us a little bit more details on that?
Well, I took the dome and I dissected it, and I said, okay, you have offers above, bids below. These people want to buy, these people want to sell. This amount of people are looking to sell, this amount of people are looking to buy. So what's causing the fluctuation in price? Why does price move then if it's just that easy? So I dialed it down into 4 components. You have passive resting orders and aggressive filled orders. So I created a chart with just that on it, and I started studying it 16 hours a day, 18 hours a day, nonstop, all day, taking trades, no kind of methodology, no strategy. And I started discovering that where I thought was the good spot to get long or short, these places were just taking everybody's stops at these specific spots. So that's how I started to put it together. Like you want to be on the opposite side of how you think you're supposed to trade.
What I'm impressed with is that you identified early on that you had to make it personal to you, right? I mean, you had to make it to where you looked at the screen and it made sense to you for you to be able to pull the trigger.
Yeah, because that's the only way to do it, I think. You could show someone anything in life, how to fish, how to work on a car, unless you do it for yourself and kind of make your own. Good example is like I taught my son how to mow the lawn, and I come out one day and he's drawing like X's in the yard. And I'm like, why are you doing it like that? And he's like, well, the way you showed me, it's not practical. So I'm doing it my way, and I think this is faster. So I let him go, and he ended up missing half the lawn and going back over it. But he was trying to make it his own, is my point.
No, I love that. And also an example you shared with me the other day, and maybe you could share with everybody here. You talked about how you put a chart out there and told everybody to draw a trend line. I thought that was pretty interesting, and talk to everybody about the results that you got from that.
Yeah, so when we had that initial chat room from School of Trade, this was before order flow, I was noticing everybody was number calling. Everybody called out a different number. So I said, there's 60 people in the room. Here's a chart. I'm going to draw a trend line on it, one trend line. Take the same chart, everybody draw a trend line, and then hand it in at this time. So I think 20 people participated, and I think 4 trend lines were the same of mine, and the rest of them were completely different. So right then that told me that basically why there's a market. Everybody is doing something different. There's people buying, selling, 100 different places, up and down. And that dawned on me, like, you have to be creative and make it your own. Like, you can't copy anyone because there's only so much I could tell you to make you draw that same trend line as mine, because that's my eyes that are looking at the chart that drew that trend line.
Let's talk about bonds and treasuries.
Okay. They're paying attention to the Fed. They're not benefiting from share buybacks at all. They're benefiting from companies not defaulting. They're benefiting from the liquidity tide, if you will. But we still have the difference between the two big benchmarks, right? The 2-year and the 10-year Treasury. That's still sitting at 25 basis points at a quarter. So what it's telling you is that markets are precariously close to hitting the fear panic button, because it's not so much the fact that the yield curve is flat or steep. What traders care about is when and if it inverts, because that hits the fear button. That is when bond markets finally begin to communicate loudly and clearly with the stock market. And what the Treasury market is telling you right now, as the short end continues to tick up, it's that the long-term prospects for the economy are not being reflected as strongly as a lot of the talking heads on bubble vision would have you believe. They'll tell you that the Fed is only raising interest rates because the economy is so strong. Well, with all due deference, the bond market disagrees with that assessment.
So what I'm hearing from you is that you don't think that rates are going to be going up much from here at all. You think they're probably stuck here for now. And, it takes me back to the technical side of things. When I look at the 10-year, to me, they're going to keep breaking. I think rates are going up. So I don't know. I mean, am I wrong for saying that you think that rates are stuck here? They're not going anywhere?
I speak to a lot of rates traders, and they've been staring at the same channel that you've been staring at, and they think this 10-year is poised to go to 3.4, whatever. I can't see it. I look at the market through a fundamental prism, and the fact that we've got the 30-year mortgage at 5%, and this is enough to slow the housing market, and the economy keys off of the housing market, and we've seen the home building stocks get slaughtered. It's telling you that households are extremely sensitive to rates, more than they should be if we're looking at a piece of paper going, but that's still really a low mortgage rate. You know what? You're right. It is really a low mortgage rate. But home prices have gone up so much, and affordability is so stretched that it doesn't take very much to shut down this housing market, and that's what we're seeing.
Okay, let's talk about a scenario here. You think that rates are stuck here. I think rates are going higher. Some of the bond and treasury traders that you speak to also think that rates could uptick from here in the 10-year. Let's say that happens. We get a 3.5% in the 10-year. I think that's very possible. I think even higher is possible. What happens then? What does the Fed do if we see that in the 10-year?
Well, I think the Fed then has to start taking into account things like what is happening overseas. Because if you're talking about a 3.5 or a 4% handle on the benchmark 10-year Treasury, then you have to start whipping out a laundry list of countries that we've just lost. Whoop, there went another country. I mean, that's how sensitive other countries are, because I don't think that the dollar is as weak as it has been if you start to see a breakout to the upside in 10-year Treasury yields. And the only reason that we've seen such nicely behaved global behavior since the 10-year broke above and held 3%, now we're at whatever, 306, 307. But the only reason that we've seen such well-behaved markets outside of the United States is because the dollar's been weak in the face of rates rising. That is not normally the way things work with markets, right? You see the dollar strengthening, you see, you look at the mirror image and you see rates rising. We don't have that right now because I think some of the rest of the world is beginning to have anxiety fits about the size of our deficit and it having to be financed going forward. But if you see a 3.5% or 4% handle on the 10%, you're going to have upside in the dollar and you're going to have other countries go. And that's going to bring the Fed back to having to take into consideration international markets and the effect that policy has outside of our borders.
Something I want to talk about with you is managing yourself after big losses. We've all had big losses, and something that I think a lot of traders, new traders especially, after they have a big loss, they really don't know how to approach the next steps. What have you done following a big loss?
Now or in the past?
Well, how about you do both and show us how you've grown, right? Show us how you've grown as a trader and how you handled it then versus now. I think that'd be interesting to hear.
Well, in the past, I used to be one of the finest revenge traders you've ever seen. Anything that anybody has ever done in the name of bad trading, I have done. But I used to compound losses with greater losses because I would revenge trade, but I wasn't revenge trading on a given stock or whatever. Most of my big losses would come from me deviating from my strategy. This goes back to me jumping in and thinking I can be a genius day trader all of a sudden. And then all of a sudden I'm in a loss position in a trade that is outside my core strategy. And for whatever reason, my brain will not allow me to take a loss in a strategy that I don't know anything about. Like, I've got no business doing this, so I have to clean this back up and get back to break even so that I can move back on to doing what I normally do and right the ship, which is such a dysfunctional way to think. But it took me a long time to figure out that this is what I was doing. So that's what would happen. And I would start to revenge trade against myself. It wasn't the stock, because I would jump around. It's like, I just go, oh my God, I just lost $2,000 doing something incredibly stupid. I could lose $2,000 in a swing trade, perfectly structured, and it would be like, yeah, that's no big deal. That happens sometimes. And it wouldn't bother me. But if I take a $2,000 loss in a day trade on Netflix, I'm beside myself because I got no business doing it in the first place. And so I would find myself doing whatever it took to make back that $2,000. And by the time I was done, I was down $10,000. So early on, I didn't handle losses very well, and it would only create more losses. As time has gone along, what I have learned is that what I need to do is two things. Number one, I have to walk away. You have to walk away from your loss, no matter how big, and I've taken some big ones. And you have to breathe for a while. You have to let that loss settle on you so that your emotions can get back to neutral. Because after you do something insanely stupid, you're not neutral. You're mad at yourself, you're mad at the market, you're mad at your dog, you're mad at everything. And you've got to wait until you find that point of neutrality where you can start trading rationally again. The second thing you have to do while you're going through that process is you have to go back and remember how good you are. I think this is so important. After you take a big loss, you step away, but you have to remind yourself that you're good at what you do when you stay focused. And I have a wife who will do that for me also, which helps tremendously. Either go back and look at performance records or whatever, but you have to remember the times when you were trading flawlessly and executing flawlessly so that you know that this is something you can do. You just deviated, or you just or the market did something you didn't expect. Whatever it is, the point is you have to get to where you know you're a good trader, because confidence is everything. So after big losses, and sometimes it takes me a couple of days, sometimes it takes me, I had one earlier this year that took me 6 weeks of walking away, staying away, processing, figuring out what happened, why it happened, how did it happen, and reminding myself that I'm really good at what I do when I do it the right way. So that's how I do it.
I want to talk about getting punched in the face and how you react to that. And I said at the beginning that that's like us losing a lot of money or blowing an account. And what we do from that moment going forward, I think, is what defines us as traders. Because for us as traders, we're all most likely going to have a big loss or blow an account at the beginning of our career. And it's just something that we've accepted. Just like a boxer goes into a fight and is most likely going to get punched really hard in the face. And it's what you do next, right, that defines you. So after you got punched in the face in the ring for, one of your fights, how did you react and get yourself mentally focused again to go back to your strategy?
This is just one of those testing points. Like, do you have what it takes? Can you get hit and refocus and bring your, get back to your strategy? How I did it personally, and some of this is my personality. I'm a very, very stoic guy. They had to push me to be fired up, and that's just not natural for the way I want to do things. But a lot of times you just have to remember that getting hit is part of the game. And if you're there long enough, or we'll scratch that, you won't be around long enough, because your emotions will get the best of you and you'll lose it and you'll start seeing red or whatever. And it really just weeds you out. Boxing very much is a sport of kind of reduction. Guys do learn things and they do progress with their knowledge, as knowledge should do, moving forward. But there's also, can you get hurt? Can you manage your adrenaline under fire? Can you think and take the information in that your coach is giving you in the corner when you're in an arena full of 1,000 people? There are these things that are very, I don't want to say impossible, because I don't think anything is impossible to teach. I think some people have a much steeper learning curve than others, but I don't think anything is impossible to teach. But these things are so important to your development that if you don't have some type of predilection towards them, that will show, and you will likely get beat out of the sport before you can express any type of mastery of the sport. Before you can be a good fighter, you're going to be a hurt fighter. You're going to be a discouraged fighter.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. You're very active on that you wrote on there. This is one of the most recent ones you wrote, and this took my attention. She's the IO, and I'm going to quote here: "Massive disruptions, digital currencies." You wrote in your post, a year that you've cryptos. You've been the future of digital assets. And that's really saying a lot, Michael Lee. And you have and you have your action with it. So what is it, what Shane Lagarde giving you point now?
And institutions to embrace that. For example, Lloyd Blankfein said a year ago, I'm not a fan. Jamie, so those are big global stupid. Look, there's massive, she meant obviously in blockchain. I think because I just realized this, just small examples. Woman who's an attorney, a Fortune 20 company. I have clients now that are buying cryptocurrencies. And I said, "What's happening?" She's like, why? I just haven't heard about it. Banks are buying Bitcoin. She's like, that's a data point. I talked to somebody that they were going to provide custodian solution. And then I talked to them. I said, why? They said, because you're going to provide that solution. You look around Central Bank, State Street, and look at the deal that ICE and Starbucks. And so it's just hard. This is just a scam. I think momentum from credible, both in the public and private sector, this blockchain revolution.
I talk to many traders, firm owners, just a lot of market participants, and they're always complaining about something. And it seems to me like this DoddFrank compliance is still something that a lot of people, aren't too happy with. So where are we with everything with DoddFrank right now?
That's a great question. So, when Dodd-Frank was passed, I was actually working at the CFTC. And I left not long after that to work in the private sector, helping firms respond to the rules. And now I work for the FIA. And we've come really full cycle. We've seen most of the rules out from the CFTC, and even to the point where we're at an opportunity to reflect and see, do they need some fine tuning? I think that's really where we are post Dodd-Frank. The market has done a lot of adjustments to accommodate. They've actually invested in technology solutions to help them comply. They've relocated offices to help them comply. So they don't necessarily want to undo Dodd-Frank because they've invested in the current compliance requirements. But there are still some things that just don't make sense. And that's not to be critical of the regulator. These are the kinds of things you don't know until you actually put them into place. And I think we've seen a little bit of a willingness from the CFTC to revisit rules. The most recent example I can think of is the rules around the chief compliance officer requirements for swap dealers and FCMs. They've changed those. They've tried to make them more manageable, more accommodating to what firms need. So I do think there's an interest there to rethink and to tweak. I'm not sure firms in general want to undo all of it because they've invested in being in the right place. But some of them, as you consider the totality of the impact, they just need to be tweaked.
You mentioned total return the other day, and to be honest, and I know that all of a sudden now they're becoming real. Everyone, what they are.
Sure, at CME is on the S&P 500 total return index, offers the SPX index future does, but it reinvests daily distributions into the index. What it provides to investors is exposure to the S&P is accounted for. You don't have that risk that you do when trading the index. So as the name implies, total return, price return of the index. This is 2016 at CME, out for a while, but it is really here at CME Group. Driven by some of the capital rule margin rule changes that are impact futures class, starting to feel some of the impactfully efficient and use. So when we've seen this futures over the last few years, about 1,500 contracts of the year, and we did about in Q3. We've 210,000 contracts of $30 billion of outstanding. Some of those open interest numbers, as well as a US dollar for a futures contract, that's pretty astounding to watch and providing very positive futures are providing equity index contracts at CME.
All of a sudden, boom. I mean,
Yeah, I think it's really because as regulatory rule changes, sometimes it takes a while to trickle down to the let's street. So more came in scope in two things around uncleared margin rules. There of time where they're as those swaps mature and moving out of it into futures, so a effect where the cyclical, and then you couple that with it and being distilled down at perhaps P&L level, which is some individual trader, there is a better alternative than the traditional counter equity index swap.
IC, which is the basis. It was also long. I was reading the other day that they're that.
Yeah, BTI basis traded index close and that successful product launch at C. That at the end of 2005, market participants to trade the cash index or the official the future, and people use where they need to manage their option risk. The delta result as a function of their variance happened to the close. Participants have had to either use cash pairs, NAV trades, and ETFs to get into futures, and we said that, and that's via BTIC, participants and customers against the close, in futures form without some of the aspects. So customers, we're just about over 30 contracts a day in our 3 times increasing. And we were talking about, just had a record last week as well, a little over 95,000 contracts and just under 100 U.S. indices, Russell 2 net. So similar to the total return future, participants are turning to OTC vehicles, or kind of where they're now getting the same type trading around the benchmark benefits that futures at CME.
You mentioned that you think that prices could see a $5 swing up once sanctions hit the market on November 4th. So talk to us about that.
Yeah, so we've been following this Iran sanctions issue and the Iran nuclear deal, from even before the handshake in the summer of 2015 between the Obama administration and Iran. On the first part, we were forecasting that there would be a deal because we felt Obama really wanted to have some kind of big foreign policy achievement. And then when sanctions were lifted, we were probably one of the few analysts out there that predicted that Iran would quickly recover production. And I think our number was about 800,000 barrels a day by the spring of 2016 when sanctions were lifted. That was, really out of consensus. Most, I think, sort of consensus or big bank analysts put the number closer to like 200,000 or 300,000. I think EIA and IEA were at 500,000 for the entire year. We were saying, no, it's going to be quick. It'll be front loaded. It'll be about 800,000 by the spring. That actually happened, and then they quickly exceeded that and got up to 1 million barrels a day as soon as the summer. So we've observed what Iran can do on the upside when sanctions are lifted. And then, Trump got elected, and we immediately began advising clients that we felt that he would actually take action on Iran. And then in 2018 wrote that we thought that it would be the beginning of the end of Iran sanctions, beginning of the end of the Iran deal, and the start of reimposing oil sanctions on Iran. And we've felt since the beginning that at least the 1 million barrels a day that Iran added to the markets when sanctions were lifted, that 1 million barrels would be the first to be impacted and taken off the market. And so, we talked about that last year, early this year. That number was kind of laughed at the time and scoffed at by others who, again, were lowballing it and sort of, doubting whether Trump would actually follow through or whether sanctions would, be effective and honored by other countries. But now that 1 million barrel a day number looks conservative. Now you're seeing, even bank forecasts talking about 1.5 million barrels a day being taken off the market. So we think the number is pretty substantial. There's been a lot of market confusion about, what this number would be. A lot of it depends on the whole issue of waivers. But I don't think the full 1 million barrels a day is priced into markets now. I think maybe half of it is. And so I think once sanctions are implemented on November 4th, and we start seeing customers of Iran, stopping or halting purchases, and it may take, 1 or 2 or 3 weeks for this to happen, I think you are going to see, oil prices rally, and we think it could be as much as $5 a barrel.
Okay, so the trader and me, when you say that we could see a $5 spike in oil, right away thinks about from where? Because as we record, crude is trading roughly just under $70. So what if crude rallies $5 between now and then? Do you think it will rally another $5? Or do you think it's just going to rally $5 right after this announcement, regardless of where it is?
Well, for me, I'm basing this mainly on Brent prices. Okay. So I think, and I've always thought that Brent would be near or at $80. I definitely didn't think 85 in September and early October was warranted from a fundamental standpoint. But I do think, we're probably right about $80. And so I do see about a $5 swing higher. It could even go higher than that. It could go close to 90 by the end of the year. But I think the average swing up is going to be about $5. And I see 85 being the average price in the last part of this year.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.